Hello everyone. Welcome to yet another episode of India Ratings and Research Expert Lounge podcast. I am Amay Bodke, part of marketing and communication team at India Ratings and Research. Today I have with me Mr. Mahaveer Jain, director and head of real estate sector at India Ratings and Research, along with joining Vinay Pathak, senior analyst at India Ratings and Research. Today we'll be discussing on residential real estate, low unsold stock, room to absorb slower pre-sales growth. I hand it over to Mahaveer.
Thank you, Amay. FY24 saw a large residential housing start. Does it mean that there is an elevated inventory risk? Let's get comment from Vinay. Vinay, hi.
Hello, Mahaveer.
Can you provide an overview of the current inventory levels in the Tier 1 residential real estate markets within the top 8 cities?
Sure, Mahaveer, I have put up the data on the screen. The Tier 1 residential real estate inventory levels in the top 8 cities are quite comfortable when compared to historical standards. We also see that the quarter to sales ratio is currently at 11 quarters, which is a notable improvement from the 6-year high of 13 quarters in FY19. Additionally, when looking at unsold stock city-wise, Pune and Bengaluru have favorable levels, whereas cities like Mumbai metropolitan region and Chennai show the highest inventory buildup.
Okay, so these are the city level data. Can you also talk about the issuer level inventory?
Sure, Mahaveer. So within the India ratings rated peers, the overall change in the year-end inventory was at 26%. Companies like Sobha and Sunteck Realty experienced the lowest inventory level changes, attributable to a lower number of new project launches. On the other hand, Godrej Properties Limited and Macrotech Developers saw the significant inventory growth due to robust new launches.
Okay, so this is the data with the under construction unsold plus the finished unsold. But if we were to sort of dissect the data and just look at the finished inventory, how does the finished inventory look like?
Yeah, so the high absorption rates in FY23 and FY24 have contributed to a comfortable quarters to sales ratio right now. As of March 24, the finished inventory to absorption ratio stands at about 14%, which is much lower compared to the historical average band of 35%. This indicates a healthier balance between the inventory and the market demand.
Okay, so the finished inventory is substantially absorbed, but the launches have gone up. So the overall under construction unsold mix is substantially gone up. So if you were to do a ratio analysis around the launch to pre-sales ratio, how has that particular number trended?
Yeah, the pre-sales growth has been strong over the past 6 quarters up to March 24, resulting in a reduction in the launches to pre-sales ratio to about 1.25 times in FY24 from 1.4 times in FY23. This is still higher than the sub 1x ratios observed between FY18 and FY20, suggesting that there is still considerable room for absorption even in the event of a slowdown in pre-sales.
Got it. Can you talk about the pre-sales growth that was observed in some of the India rated peers?
Of course, Mahaveer. India ratings rated peers having residential real estate inventory experienced a record 71% year-on-year pre-sales growth in Q4 FY24, marking the highest growth in the past 7 quarters. Godrej Properties Limited led the pack with 95 billion rupees in pre-sales, followed by Macrotech Developers at about 42 billion rupees in pre-sales. Notably, Mahindra Lifespace Developers posted the highest year-on-year pre-sales growth at about 201%, followed by Godrej Properties at 135% and Puravankara Limited at 93%.
Unprecedented, right? I mean, these kinds of growth levels are unprecedented. How is the collections trending?
Yeah, so on the collections front, the PSAT aggregate collections grew by 29% year-on-year in Q4 FY24, the highest in the past 7 quarters. However, collection efficiency, which is measured by collections to pre-sales ratio, has decreased to 66% at the end of March 24 from 87% at the end of March 23. So this drop indicates a higher share of early stage projects in the development portfolio. Shobha reported the highest collection efficiency at 100, while Macrotech maintained an efficiency of over 80%.
I get the point. So the pre-sales have grown at 71%, while the collection ratios are at 29%. So what implications does it have on the balance sheet leverage?
Yeah, so when we look at leverage intensity, which is measured by the gross debt to pre-sales ratio, the same has decreased for Macrotech and Irwin, but has increased for Mahindra on a year-on-year basis. Overall, Irwin, Shobha, and Mahindra remain low leveraged. However, players with significant commercial real estate under construction show higher leverage. The PSX leveraging intensity reduced to 53% of pre-sales from 59% of pre-sales year on year. Yet, the gross debt to collections ratio slightly increased to 2.4 times at FY24 from 2.3 times at FY23 due to the high launches and lower collections from early stage projects.
Thank you, Mahaveer and Vinay, for such an insightful discussion. For more insights on the report, please visit to our website on www.indiaratings.co.in under the Research and Publication tab. Thank you, everyone.